In this session, we'll be diving deeply into one of the most crucial financial metrics, price to earnings ratio. It's also known as PE ratio for short. Whether you're studying for exams, pursuing professional certifications, or a finance professional navigating real-world scenarios, understanding the PE ratio is essential. It helps investors, analysts, and decision makers assess the market value of a company's stock related or relative to its earnings. Stick around as we break it down with a practical example that you can apply in your career. Let me share my screen quickly as we look briefly into this fantastic financial metric. All right, I've gone beginning now. Once again. All right, so let's look at the price earnings ratio. It compares the earnings per share with the market price of ordinary shares to calculate the number of years it would take to recover the market price for a share if earnings remain constant in the future. This is very important. Take that again. Compares the earnings per share with the market price of ordinary shares to calculate the number of years it will take to recover the market price for a share if earnings remain constant in future. It is calculated as market price per ordinary shares divided by the earnings per share. The PE ratio is widely used as a financial metric that compares a company's current share price to its earnings per share. It's a key indicator for investors to assess the market value of a company's stock relative to its earnings. It also helps the investors determine whether a stock is overvalued, undervalued, or fairly priced based on its earnings potential. So having the market price determined by the stock market, forces of demand and supply in the stock exchange, the earnings value of the company in form of earnings per share is used to measure this ratio to determine if it's overvalued or undervalued or fairly priced in the market. The formula is also graphically shown as market price per share divided by the earnings per share we just calculated in the previous video, where market price per share is the current trading price of one unit or one share of the company's stock in the market. And the earnings per share is the company's profit attributable to its outstanding shares, as we just calculated by taking the profit after tax, deducting preferred dividend, and dividing it by the nominal value of the shares. So by way of illustration, let's graphically calculate this ratio and look at practically what it means and how to address this ratio. Still using Shallow to Nigerian PLC, from our note information, we see that a caveat was stated there, which states the proposed share price on the Nigerian Stock Exchange is 5 naira per share. So let's take that 5 naira as the market price per share. 5 naira as the market price per share. Let's come to our Excel, post it as 5 naira. So we have it as 5 naira market price per share. We have our earnings per share as just calculated 0.13, which includes 18 kobo graphically. Don't forget, we just calculated the earnings per share. We have 13 kobo as our earnings per share. So just pick that and post it as our earnings per share. So to have our price earnings ratio, which is PE ratio, simply divide market price per share divided by our earnings per share. We have 38 naira 46 kobo. So this is the potential amount investors are willing to pay for the shares. The value the market looks at the shares is 38 naira. This is high. It shows the potential, the futuristic expectation of this company shares in the eye of the market. So what does this mean? What does this mean? The PE ratio shows how much investors are willing to pay for each naira of the earnings. So in the case we just calculated now, investors are willing to pay 38 naira 46 kobo as much. Looking at the earnings potential of the company. This is very good. It shows a high ratio. Why a higher PE ratio suggests that the market expects strong future growth. Sure. And we just saw that in the PE calculation, 38 and 48 kobo. Why a lower PE ratio may indicate that the stock is undervalued or that the company has slow growth potentials. The ratio is often used to compare companies within the same industry, and the implication of a high PE ratio indicates that investors are expecting higher future earnings growth and are willing to pay premium for the stock. However, it can signal that the stock is overvalued, where we have this high amount of PE ratio calculated as much as 38 naira 46 could be perceived as overvaluation of the share, while a low PE ratio may suggest that the stock is undervalued, presenting a potential buying opportunity, but it will also reflect concerns about the company's future growth and prospects for profitability. So where there is a low or negative earnings per share of the market price per share, shareholders or investors will be concerned about the company's growth prospect and future profitability. So what are the causes and effects of a high PE ratio? Cause number one is high investor confidence, strong growth potential, optimistic market sentiment, or current low earnings compared to future expectation. So these are the causes of a high PE ratio. Notably, investor confidence is boosted, growth potentials are clear, and optimistic market sentiment. While the effects is that stock may be more expensive, like we see over 38 naira 46 kobo in the case of Shell to Nigeria PLC, attracting growth-focused investors, but also increasing the risk of overvaluation. This is critical and must be assessed very, very objectively. While a low PE ratio is caused by slow growth, declining earnings, where profit may not culminate in distribution of dividends, market pessimism, or the stock being undervalued in the market. And the effects is to attract investors looking for a bargain, but might also indicate concerns about the company's future earnings potential. So in conclusion, the price to earnings ratio is an essential tool for evaluating a company's stock price relative to its earnings. It helps investors make informed decisions about whether a stock is worth buying, holding, or selling based on its valuation. So the PE ratio helps shareholders and value creators that have invested in that company to see if their stock is worth holding in the short and the long run, or selling it off to reinvest or divest in other companies. But to hold the stock, looking at the earnings potential and futuristic returns of this company, or selling it based on its current valuation to either make profit and divest to something else. So investors make informed decisions based on the PE ratio, and this is very critical. So while a high PE ratio may indicate growth potential, it can also signal overvaluation, like we said earlier. A low PE ratio may also presents an undervalued opportunity or suggest future challenges. So investors should use the PE ratio alongside other metrics to make a comprehensive assessment of the situation. Also, chartered accountants in training, finance professionals can advise investors and the company on how to comprehensively make risk assessments on these ratios and which other ratios to juxtapose or use pari passu to understand understand these ratios to make investment decisions. All right, now we've seen how the PE ratio works. That wraps up our exploration of the price to earnings ratio. Remember, whether you're analyzing stocks in your personal investment portfolio or assessing companies in your professional accounting room, the PE ratio is a key tool for making informed decisions. Always keep in mind, it's just one piece of the puzzle. Don't forget to use it alongside other metrics for a comprehensive evaluation. If you found this video useful, hit the like button, subscribe for more insights, and drop your questions in the comments. See you next time. Until then, bye for now.